Okay, let's unpack this. We are diving into the Q3 2025 earnings results for Circle Internet Group, Inc., released just today, November 12th, 2025. Our mission: quickly synthesize really explosive growth and the key strategic direction here. They're guiding the build out of their big vision, the economic OS for the internet.
Yeah, it's quite a report. You rarely see such almost opposite things happening. You got operational performance that just absolutely crushed expectations.
Right.
But then the market reaction signals, well, some concern. We kind of need to figure out why.
Exactly. So let's start with the money, the financials. The Q3 results, they really did blow past forecasts pretty much across the board. Total revenue and reserve income hit $740 million. That's a solid 66% year-over-year growth.
And importantly, this isn't just, top line growth without substance. The operational discipline, it flowed right down to the bottom line. Net income from continuing operations was $214 million. And there's a stunning 202% increase compared to Q3 last year.
Wow. The analysts must have been, well, floored. Earnings per share, EPS, came in at 0.64 cents, which just smashed the street forecast of 0.34 cents. That's an 88.24% positive surprise. It's hard to picture a much better quarter for just raw profit numbers.
Yeah, it really speaks volumes about the network effects they're managing to capture. And to really get the sense of the underlying health, you kind of have to look at the non-GAAP stuff too. That shows the pure operating leverage. Adjusted EBITDA, for instance, grew 78% year over year, $166 million.
And the margin story here is, well, phenomenal, right?
Absolutely. The adjusted EBITDA margin expanded significantly. It hit 57%. That's an expansion of 737 basis points year over year. It just shows they're scaling their infrastructure cost way slower than their revenues growing.
Okay, so where did that $740 million actually come from? Let's break down the revenue streams a bit.
Good point. The vast majority, $711 million, that came from reserve income. Basically, the interest they earn on the assets backing USDC, and that was up 60% year over year, which makes sense. It's directly tied to the 97% growth in average USDC circulation.
So more USDC out there, higher rates.
Yeah.
That's their core profit engine right now.
Exactly. It's a function of high rates and massive asset growth. But here's where it gets interesting. Their fee-based revenue, what they call other revenue, that grew really strongly too, at $29 million. Now, that's an increase of $28 million year over year, a huge jump percentage-wise. And this segment, it includes things like transaction fees, platform services. It's arguably higher quality revenue in the long run.
Right, which leads us to their internal efficiency metric, RLDC, revenue less distribution costs. The source material highlighted that the RLDC margin actually strengthened to 39% this quarter. Why is that specific margin so critical for you listening to understand?
Well, it's crucial because for a stablecoin issuer, those distribution costs can be pretty significant. Think paying partners, clearing fees, managing reserves, stuff like that.
Yeah.
RLDC strips away those sort of mechanical costs. And it gives us a much clearer picture of the profitability of their core operational services, the platform fees, cross-chain transfers, subscriptions. When that margin expands, it signals their actual service offerings are scalable and high margin, which helps offset, potential future risk if interest rates become volatile.
Got it. So the core engine's strong, and those other engines, the other revenue, are finally starting to rev up. Okay, now let's pivot to the asset that makes it all work, USDC itself. The network metrics show both unprecedented size and just staggering velocity. Yeah, the size first. End of period USDC in circulation reached $73.7 billion. That shows 108% year-over-year expansion. I mean, that number alone is a major statement.
Seriously, reading these numbers, it kind of felt like watching a rocket take off. But what does $9.6 trillion in transaction volume actually, feel like? What does it mean? USDC on-chain transaction volume in Q3 was $9.6 trillion. That's 6.8 times year-over-year growth, or 580%.
It means USDC isn't just sitting there in wallets like digital savings. It's actually being used as intended, right? As a medium of global exchange. That kind of velocity shows powerful utility. And utility, that's the key driver of the network effect.
And that effect is reaching actual users, too.
Exactly. Meaningful wallets, they define that as holding more than $10 in USDC, grew 77% year over year, hit 6.3 million.
So that growth rate, 108% circulation growth, it suggests they're pulling away from competitors, doesn't it?
It does. I mean, the overall stablecoin market grew, and it grew quite robustly at 59% year over year. But Circle grew almost twice as fast at 108%, and this allowed USDC's stablecoin market share to climb to 29% as of Q3. But here's the strategic kicker. Their transaction volume share accounted for 40% of all stablecoin transaction volumes.
Ah, okay. So they hold 29% of the assets, But those assets are responsible for 40% of the actual movement. That points to higher utility, like you said, a utility premium.
Precisely. And they're also building out the tech infrastructure to keep this lead. USDC is now supported across 28 blockchain networks. They added 5 new chains just in Q3. They're clearly laying the groundwork to handle, well, pretty much every corner of the digital economy.
And you need the right plumbing for all that volume. How's their key infrastructure layer doing? The cross-chain transfer protocol, CCTP.
Right. CCTP is basically the secure way to move USDC natively between different blockchains. Its volume hit $31.3 billion in Q3. That's a 7.4 times increase year over year. And maybe to put that into context for you listening, CCTP represented 47% of all bridged volume across the major providers.
Wow, so nearly half of all significant cross-chain digital dollar movement is flowing through Circle's system. They're not just a player anymore, they're rapidly becoming the central hub. That feels like a pretty deep strategic moat being dug right there.
It absolutely is. And, well, that brings us right back to the tension we flagged at the start. Despite this incredible performance, this dominant position, that huge earnings beat, the stock got hammered. It fell 7.42% in pre-market trading and was down over 11% during the main session on November 12th. Why?
Yeah, if they beat EPS by 88%, why the sell-off? I mean, the standard answer is always investor focus on future guidance. But let's dig in. What exactly in the guidance spooked the market so much?
It looked like a classic Wall Street dilemma, really. The tension between immediate profit and strategic long-term spending. Let's start with the good news in the guidance. They kept the long-term metric for USDC circulation unchanged, still guiding to a 40% compound annual growth rate, CAGR, multi-year through the cycle. That signals ongoing confidence. And they also raised their guidance for that high-margin other revenue stream to between $90 and $100 million.
Okay, so they feel good about their subscription and service revenue scaling up. So what was the bad news, or at least the perceived bad news?
It was the raised expense guidance. Adjusted operating expenses guidance got bumped up significantly, now expected between $495 million and $510 million. That's up from the prior range of $475 to $490 million. So that's roughly a $35 million increase at the midpoint.
Right, and the market sees that immediate spending jump and thinks lower near-term profit. But what was management's specific reason for this? Well, this $500 million plus investment plan.
They were pretty clear about it. They called it deliberate strategic investment. It's meant to meet the accelerating market interest they're seeing from institutions and partners. So they're essentially pouring money into 2 main things. 1, rapidly building out their platform capabilities. And 2, scaling up their global partnerships and the associated compliance infrastructure. Oh, and it also includes higher expected payroll taxes from stock option exercises, which hints at hiring and retention efforts.
Okay.
So management is basically telling the market, look, we're sacrificing some near-term margin to cement a long-term advantage in what we think is a winner-take-most market.
Right. Though the market might worry that this strategic spending is actually just a sign of tougher competition, forcing their hand. But if they are investing this much, where is it going specifically? Which brings us perfectly to the platforms meant to drive that future growth. The whole economic OS idea centered on the ARC network.
Yeah, ARC network is positioned as the foundational layer. They describe it as a purpose-built Layer 1 blockchain designed specifically for stablecoin finance and real-world economic activity. The big goal is to build an environment where financial services can operate entirely on-chain, with USDC as the native settlement asset.
And the institutional interest in this foundational layer, it's frankly kind of staggering. They launched the public testnet with over 100 participants, and we're not talking small players. We're talking massive financial institutions like Apollo, BlackRock, HSBC, Standard Chartered, plus major tech players like AWS, MasterCard, Visa.
Yeah, that list is really important. It shows that the regulatory shift we mentioned earlier, the Genius Act in the U.S., has been genuinely transformative. These big institutions, they're not just watching anymore. They're actively testing, actively building within this compliant framework Circle's providing. They expect the mainnet launch sometime in 2026.
Okay, but here's a really critical strategic point we should probably drill down on. They mentioned they are actively exploring creating a native token for the ARC network. Why would a centralized, regulated stablecoin issuer like Circle want a native token, especially one meant to, quote, enable decentralized governance? That seems interesting.
It is interesting, isn't it? That's sort of the core tension that makes this strategy fascinating. Exploring an ARC token seems to serve a few strategic goals. First, legally, it could help differentiate the decentralized open source network layer ARC from the centralized regulated issuing company, Circle.
Ah, okay. A separation.
Right. Second, to really attract the best developers and power users globally, you arguably need a more decentralized structure, one where stakeholders can actually participate in governance and where incentives are aligned through the token itself. It's probably necessary to bootstrap that network effect and make sure ARC is seen as a neutral platform for institutional finance, not just, a Circle corporate product.
That makes a lot of sense. Building foundational internet infrastructure kind of requires perceived neutrality, and in crypto, that often points towards decentralized governance.
Exactly. So if ARC is the foundation, the application layer on top is also showing some pretty explosive growth. The Circle Payments Network, or CPN.
The momentum here is just wild. CPN showed, and this is their term, 100x growth in trailing payment volume processed TPV just since June. It hit an annualized TPV of $3.4 billion as of early November. That kind of growth rate usually signals product market fit, but it sounds like there's still a ton of room to run.
Oh, absolutely. The pipeline numbers are what should really grab your attention. They have 29 financial institutions already enrolled. Another 55 are currently undergoing eligibility reviews. And then there are an astounding 500 institutions in the pipeline waiting. And this ranges from the huge, global, systemically important banks, the GSIBs, all the way down to fintechs and specialized cross-border payment firms.
Wow, that 500 institution pipeline, that tells you the global financial system is really hungry for this kind of solution.
And they're building the global infrastructure to meet that demand. CPN already has live payment flows in 8 countries, and they have upcoming launches planned in major markets like the European Union, Colombia, the Philippines, Singapore, the UAE, and the UK. This global expansion definitely helps explain some of that increased operating expense guidance we talked about.
Makes sense. Okay, before we wrap up this strategic overview, we have to touch on their tokenized money market fund, USYC. This really highlights the institutional appetite for tokenizing traditional financial products.
Yeah, USYC has seen huge growth, over 200% since the end of June 2025. It's reached approximately $1 billion in assets under management, which makes it the second largest tokenized money market fund globally. It's just tangible proof that institutional capital is finding these tokenized products trustworthy and efficient, likely driven in large part by that regulatory clarity.
Which brings us neatly back to the regulatory environment. The source material seemed pretty insistent that the U.S.'s Genius Act was a major catalyst here.
Yes, it was definitely framed that way. Described as unlocking significant institutional willingness to actually embrace stablecoin tech. The partnerships you're seeing now with big names like Deutsche Börse Group, Visa, Unibanco Itaú in Brazil,
Yeah.
they aren't just opportunistic. They seem directly enabled by Circle having a compliant, regulated infrastructure ready to go as the new legal framework solidifies. So for Circle, regulatory clarity is actually translating into strategic revenue and faster adoption.
Okay, so to try and synthesize all this for you listening, we saw truly exceptional operational performance across all the key financial and network metrics, highlighted by that massive 88% EPS beat. And it seems driven by accelerating network effects around USDC. But this success is kind of juxtaposed with a very clear strategic decision to ramp up spending significantly, which resulted in that short-term stock market dip. It really suggests the market reacted, maybe emotionally, to the near-term costs, rather than strategically buying into the long-term investment story.
Yeah, the central narrative coming from Circle seems to be, we're doubling down. Doubling down on the belief that stablecoins are fundamentally a winner-take-most market, and that winning position is built on 3 pillars. Those deep network effects, like the $9.6 trillion in volume, massive liquidity, and crucially, regulatory moats, that $500 million plus operating expense budget. That's essentially the cost of cementing that winner-take-most position on a global scale.
Which leaves us with a final provocative thought for you to mull over. The CEO stated they are building a full-stack internet financial platform company where blockchain is the foundational OS. Now, if Arc Network does successfully launch a native token to align incentives and drive decentralized governance, what are the biggest long-term risks facing traditional financial service providers who are not currently participating in Circle's testnet as this new economic OS starts to mature?